Was the AIG bailout during the Great Recession necessary? Imagine a giant insurance company on the brink of collapse, with billions of dollars in risky investments. That was the situation with American International Group in 2008. The company was deeply involved in credit default swaps, which are like insurance policies on debt securities, including risky mortgage-backed assets. When the housing market crashed, AIG faced massive losses and was close to going bankrupt. If it had failed, it could have caused a chain reaction, shutting down banks and financial markets worldwide. The U.S. government stepped in on September 16, 2008, with an emergency loan of $85 billion to keep AIG afloat. This was just minutes before the company might have gone bankrupt. Later, support increased to about $182 billion through the Federal Reserve and the Treasury. The idea was that AIG was too big to fail, meaning its collapse could have caused a financial disaster for beyond the company itself. The bailout was designed to give AIG time to recover and to protect the broader economy. AIG's troubles stemmed from its aggressive selling of credit default swaps without enough reserves to cover potential losses. The company underestimated how bad the housing crash could get and didn't have enough financial buffers. When the crisis hit, AIG's insolvency threatened to freeze credit markets and cause chaos among banks and investors globally. Without intervention, the failure of AIG could have led to a domino effect, worsening the economic downturn. From a financial history point of view, the AIG bailout shows how interconnected modern financial institutions are. The failure of one large company can threaten the entire system. It also highlights the challenge regulators face in balancing the risk of moral hazard, where rescuing firms might encourage risky behavior, against the need to keep the economy stable. The bailout prevented a disorderly sale of AIG's assets, which could have pushed asset prices down sharply and deepened the recession. It also gave the company time to restructure and repay the government. By 2013, the government had recovered its initial investment and even made a profit of over $22 billion. In the end, the bailout was seen as necessary to prevent a total collapse of the financial system. It helped stabilize the economy during one of the worst economic crises in recent history. While controversial, it demonstrated how government intervention can be vital in extraordinary times to protect the broader financial health of the country.